Hi, this is Mark Item with HONU Trading and a special presentation about Timeframe. Now you see at the bottom it says Mark Item CMT CFA. Those are the professional certifications in technical and fundamental analysis respectively. Chartered Market Technician, Chartered Financial Analyst. I will talk a little bit more about those today as we will get into both fundamental and technical analysis. So our disclaimer is education only, not recommendations to buy or sell. And really it's this third line that is the purpose for this particular video. Know your time frame and risk tolerance. Today we'll explore exactly what I mean by the concept of time frame. Never forget that job one is risk management, and by that I mean loss control. Minimizing your drawdown, controlling your risk. Follow me on Twitter, at HONU Management, at HONUMGMT. So here's our agenda for today. What is time frame? We'll talk about fundamental and technical analysis. What is a trend, how long they last, and which chart period we review. How much time do we need to invest for each given time frame? We'll talk about the relationship between stop placement and position sizing for each of the time frames. I'll briefly touch on tax considerations, and then which time frame is best. Spoiler alert, it's totally personal choice. I'll also introduce the concept of trading around a core position, or in essence, combining time frames. So what is time frame? How long is your desired holding period? Ideally, we want to hold things long term as that's where the biggest gains come from. But that's also where the biggest drawdowns come from. And how much pain can you take? It's one thing to intellectually say, yeah, I could handle a 30% drawdown. It's another thing to even conceptualize, gee, my $100,000 portfolio shrinks to $70,000. But it's still something entirely different to actually experience that and to feel the pain, the blood pressure rising, your heart rate increasing. How much pain can you take? What's your plan for dealing with that pain? The more you think about this in advance, hey, am I going to use some kind of a hedging strategy? Am I going to just recognize I need to ride this out? What is my plan? As Iron Mike Tyson observed, everyone has a plan until they get punched in the mouth. And if you find all this valuable, take a moment to punch that like button and hit subscribe. Fundamental versus technical analysis. Fundamental analysis is all about the business, and this is where the Chartered Financial Analyst certification comes into play. As we analyze a business from the standpoint of accounting, how many dollars do they generate in sales from the products and services they provide? Of that, how many of those dollars trickle to the bottom line, if you will, as net earnings? And how does the company employ those earnings to affect their financial strength on the balance sheet and cash flow statement? Technical analysis, however, is all about the stock, and it is the study of price and trend. This is where Chartered Market Technician comes into play. That is the professional certification in fundamental analysis, where price and trend and volume are what we analyze. What is the current price? That's the absolute market value of that stock at this point in time. It doesn't matter if you think it's expensive or cheap or overbought or oversold. Those are all opinions. I can't trade any of that. I can't trade a PE ratio. I can't trade an oscillator reading. All we can trade is price. And price is what changes the trend, as we'll see in a moment. So in Trends 101, an uptrend, very specifically, is a series of higher highs and, more importantly, higher lows. It's the higher lows that really define the uptrend until broken. And then a downtrend is a series of lower lows, but yet more importantly, lower highs. We have to ask, what is a significant high or low? So as we're coming out of the dot-com bust back in 2003, you have a series of lower or about equal highs. And then you have this little jiggle. Personally, I would not contend that that is a significant high. I would disregard that in terms of looking for a change in trend. Yet when price breaks through these relatively equal highs, that marks my change in trend from down to up. And then we have a series of higher highs along the way, and more importantly, higher lows, until we get to this area. This is basically almost a year, early 2004 into early 2005. We're looking at each data point being 1 week, and this is your long-term time frame. So here I have a high, a low, higher low, lower high, slightly lower low, not really by any significant means, slightly lower high, and then you have this. And this probably is a more significant low than either of these two. This is where technical analysis is more of an art than a science. Remember this particular point in time for when we talk about stop placement. One of the points I'll make is that we need to have our stop wide enough to take into account these kind of wiggles. Nonetheless, here we are back to an uptrend. I would not consider that to be a significant low. What we're looking for is where is there a noticeable change in direction. So higher low, higher low, higher low, higher low, about equal, and then it breaks. Now, does that constitute a change of trend right there? But we have to remember, we got to analyze this in real time. We're making decisions in conditions of uncertainty. More on that in a moment. But nonetheless, when it breaks clearly below this, that's a change in trend. Now, if you decided to take some profits here or perhaps sell out entirely, it's maddening to see it drop and then rally right back into where it broke down from. Yet this happens far more often than you would actually expect. What once was a floor or a support level becomes a ceiling or a resistance level. And then in 2008, of course, the bottom falls out. So again, we're making decisions in conditions of uncertainty. To paraphrase King Leonidas in the movie 300, this is trading. So Trends 101, how long is a trend? Long-term investor, as we just saw, we're looking at weekly charts. Every data point represents a new week, and those trends last months to years. Intermediate term, or what we would call perhaps position traders, we look at daily charts, and those trends last week to month. We'll take a look at that in a moment. Shorter term, what we call swing traders, want to try and catch the so-called swings in the markets. Those trends last a few days to a few weeks, and we're looking at the longer term, but intraday charts, 15 to 30-minute bars. Intraday traders, those trends last minutes to hours. You're looking at the shortest term intraday charts, 1 to 5 minutes. Now, one caveat, the shorter your time frame, the more just random noise you get in your data points. The longer term time frame, the bigger picture you're looking at and the less the noise. Is one better than another? Again, totally personal choice. So let's look at an intermediate term time frame from before the COVID crash. Now that is about as pretty as an uptrend gets. That's pretty too, but that's about as pretty as it gets. And then kaboom. Now here you have a low, higher, lower high than now you have a higher low, and then you're off to the races here. Now, I don't know if you would pick up this particular trend right here. I know I didn't personally, but that nonetheless is perhaps an intermediate term change in trend. And then we have higher or about equal lows, all the way up to here. Change in trend, then change back in trend. Again, this is trading. Sometimes you're going to sell at a certain point over here, only to wind up having to buy it back at a higher price. But as we're making the decisions right in here, we have no idea if this is going to become this. What looks like a beginnings of a downtrend might very quickly get reversed, or it might get even worse. This is trading. Okay, so intraday time frame, and this is your swing trading time frame. There's a lot of noise in this particular chart. These are gaps, and there's no trading between here and here. and then again, no trading between here and here. This doesn't show up very well on a line chart, but I'm going to be consistent and look at the same type of data throughout. Here we get a more consistent downtrend, and this is where we were going into last Friday. So this is a downtrend that lasts literally a few weeks. That's a long-term trend in the short-term time frame. And then we get to the intraday data, the 3-minute data points, and this is all over the place. It's up, it's down. Again, a lot of random noise. Here, a long-term trend lasts about 3 days. So how much time do we need to invest in each of the given time frames? Well, it's ironic, the shorter the time frame, intraday trading, you need to pretty much devote full time to execute. The shorter the time frame, the more time is required. The longer the time frame, for longer term time frames, hey, maybe you can devote an hour a week, an hour a month even. The longer your time frame, the wider the stop needs to be, as we looked at in that long-term trend example, so that the normal wiggles don't stop you out. Therefore, the smaller the position size and or the greater the dollar fluctuation. The smaller the time frame is just the opposite. You can have much tighter stops, take bigger position sizes, and have the same amount of dollar risk. Now let's talk a little bit about tax considerations. Now, short-term trading is better done in retirement accounts, and you notice there's 3 great big asterisks here. I'll cover that here in just a moment. But because of long-term capital gains tax treatment, if you are in fact holding things long-term, that's perhaps better done in a taxable account because you get the favorable 15% tax treatment as opposed to ordinary income from either shorter-term capital gains or anything that comes out of traditional retirement accounts. Those are taxed as ordinary income. And then there's this thing called wash sale rules. These are the bane of the short-term trader. If you sell something at a loss, there's basically, if you're looking at this particular day, looking back 30 days and looking forward 30 days, if you purchase that same security, the IRS will disallow your loss. Now, let's go back and talk about these 3 asterisks. Shorter term trading is better done in retirement accounts, but only if you have proven that you can be profitable. If you are not a profitable trader, you not only cannot deduct losses in your IRA like you can in a taxable account, and by the way, you can only deduct losses up to $3,000 in a taxable year. Again, check your tax advisor to be sure. But you can hold those losses to offset future gains. You cannot do that in a retirement account, and even worse, by law, you're limited into what you can contribute in a retirement account. And if you lose money in your retirement account, you can't put it back. So for taxable accounts, there is something called Section 475 or trader tax status. This is where you need to not only consult your tax advisor, but consult a specialist in tax for traders. If you have a broken bone, your cardiologist might be able to help, but not as much as an orthopedist. So find a specialist that deals with your particular issue. Section 475 trader tax status is in essence mark-to-market accounting. You are running a business. And the simplistic version is you add up all of your sales at the end of the year, and those are the revenues, quote unquote, of your business. You separately add up all of your purchases, and that becomes your cost of goods sold. The difference is a net profit or net loss. It eliminates wash sales, which is terrific for a short-term trader, but there are specific rules that you need to be able to meet to qualify. Now, you can be a Section 475 trader while you are gainfully employed full-time. Personally, I had trader tax status since 2016 when I was still working full-time for Schwab. But there are specific rules, and you, again, really need to get some professional help. I'm going to give you 2 different tax advisors. I don't receive any income from referring to either of them, so there's no conflict of interest. And personally, I've used them both. Green Trader Tax is perhaps the largest and best known nationwide. If absolutely nothing else, they offer a trader tax guide, reasonably priced for about 60, 70 bucks. Now, I did use these folks back in 2016 to help establish trader tax status, to do a consultation to see if I really qualified. The other one is a little bit smaller firm, but still operates national, and this is Trader Tax CPA. Brian is also a veteran, which I kind of like, but he helped me set up a S-Corp and an LLC, which can add some additional trader tax benefits. Check out them both and see which one works for you. Finally, let's sum it up and say which time frame is best. Well, it's totally a personal choice. There's no right or wrong answer to this. If you cannot handle the drawdowns that come with long-term investing, that's fine. Recognize that. You can't take that much pain. But if you also don't have enough time to devote to trading in the short-term time frame, then that's a problem too. So there's no right or wrong answer. It's totally a personal choice. Now let me introduce something called trading around a core position. Let's say your target position size is around 500 shares. So you might use some variation of 300 shares held long-term, evaluated on the weekly charts, and then add or subtract 200 shares based on intermediate time frame on daily charts. Now, I'm not saying 300, 200. Maybe it's 250, 250. Maybe it's 200 long-term, you add and subtract 300. But that's what's called trading around a core position. So a review from today, we covered what is a time frame, fundamental and technical analysis, what is a trend, how long they last, and which chart period, how much time do we need to devote as individuals for each time frame, stop placement and position sizing, tax consideration, and which time frame is best, combining time frames with trading around a core position. And again, if you find this valuable, punch the like button and hit subscribe. As my buddy HONU always says, small losers win.